tomorrow will be a new day and what will really impact the markets tomorrow. To the big policy story of the day, which just broke a few hours back, which is bound to have an impact on the markets tomorrow. In what is really DIAA has really amended the double taxation treaty with Mauritius, which paves the way for India to impose a capital gains tax on all share transactions after the 1st of April next year, that is April 2017. And Sapna Das joins us with all the details of that development. Sapna, good to have you on the show. So these are some big changes made by the government, especially since this amendment will have a direct impact on the treaty with also Singapore, not just Mauritius.
That's right. Hi, Nisha. In fact, this entire exercise, has been ongoing since the last 23 years. Last 23 years, the government of India has been trying to work it around. Probably the time was right now. So on May 10, as per the release, the details are there in the release itself. May 10, this protocol was signed with the Mauritian government. And from come April 1, 2017, there will be no capital gains tax exemption from on shares which are transacted by Mauritius-based entities. So this basically entails that on listed shares, you have a short-term capital gains tax of 15%, nothing in terms of long-term capital gains tax, and for unlisted shares, the rate is going to be 40%, and for long-term, it will be 10%. The only relief here is going to be the fact that a 2-year transition period has been given. So basically from April 1, 2017 up to 31st March 2019, in case an entity passes the test of an LOB, that is a limitation of benefit clause, and that's what you were referring to. That will also now get revised in under the Singapore Treaty after the Mauritius agreement has gone through. So if the LOB test is passed, and for that you need an enterprise strength or other business strength of 27 lakhs in the preceding 12 months. That means the ongoing current financial year onwards, the enterprise size should be 27 lakhs, so that from April 1, 2017 up to 31st March 2019, you can pass the LOB test, and hence you'll be eligible for a 50% cut in the capital gains tax rate. So in case your tax rate is 15%, the rate will be 7.5%. But again, this is only going to be there for 2 years. So first thing is that post-April 1, 2017 onwards, there'll be no capital gains tax exemption that will be available under the Mauritius DTA. As of now, there was no tax on other sides. India did not have the right under Article 13 of the treaty, and that is what has got amended right now. And the Mauritius regime also did not have any kind of a taxation regime on this front. So that goes. Second, the LOB has been brought in to give the transition. That will also have a 50% concession rate in terms of the taxable rate that we levy. And the third aspect, of course, is the fact that from 1920 onwards, the LOB benefit is not going to be available in terms of any concessional rate.
That's right.
So this is again applicable only for 2 years. Hence, a lot of people are also asking this question that what is going to prevail, the amended Mauritius DTA or the GAR? Because GAR is also expected to roll out from the next financial year onwards. And here the Income Tax Act, income tax laws are very, very clear that GAR will prevail over the DTAs. There is no confusion or any doubt on that front, except that why I've explained it with the LOB 50% concessional rate point is that once the full rate kicks in from 1920 onwards, Nisha, you don't require the GAR provisions actually. Because, everything will be as is. You don't really need to go and claim that benefit and, prove yourself that, yes, I am under the LOB and this is my enterprise size and hence, I should be given a concession rate. It's just a transition. So when the full rates roll out, in any case, the GAR test may not be required.
Right. All right. So that's a very, very pertinent point and an important clarification that you mentioned, Sapna. Thanks so much for getting us all the details